For centuries, the wealth and stability of nations have been determined by their control over maritime trade routes. Today, in our highly globalized world, this dependency is more critical than ever before. Modern logistics rely on a vast network of shipping lanes that connect global supply chains across oceans. However, this entire system of international commerce has a series of severe vulnerabilities known as maritime choke points. These narrow waterways act as gatekeepers for the global flow of energy, consumer goods, and raw materials. Among all these narrow passages, there is one choke point that stands as the ultimate regulator of the global economy. This is the Strait of Hormuz, a crucial body of water situated between the Persian Gulf and the Gulf of Oman. To understand the global financial landscape in 2026, one must understand the geopolitics of this vital strait. Any disruption in this single passage has the power to send shockwaves through financial markets worldwide. Today, we will look at how this choke point operates, the scale of trade that flows through it, and the consequences of a potential closure. Geographically, the Strait of Hormuz is remarkably narrow, bordering Iran to the north and Oman to the south. At its narrowest point, the strait is only 21 miles wide, limiting the space available for shipping channels. To ensure safe navigation for massive tankers, the shipping lane is divided into inbound and outbound corridors. Each of these traffic lanes is only 2 miles wide, separated by a 2-mile-wide buffer zone. This means that giant cargo ships and tankers must navigate a highly restricted path under the watchful eyes of regional military forces. The shallow waters of the strait also restrict the movement of large vessels, forcing them to follow deep channels. This geographical constraint makes the ships highly vulnerable to monitoring and potential intercept by local patrol boats. Despite its small physical size, the economic weight of the strait is absolutely staggering. According to energy data, roughly 20 million barrels of petroleum flow through the Strait of Hormuz every single day. This volume represents approximately 20% of the world's total petroleum consumption. To put this in perspective, it is double the daily oil production of the entire United States. The oil transported here is destined for major economies across the globe, particularly in the Asia-Pacific region. Countries like China, India, Japan, and South Korea rely heavily on the Persian Gulf for their primary energy imports. Japan, for instance, imports over 80% of its crude oil through this single maritime choke point. For South Korea and Taiwan, the dependency is similarly high, making their industrial sectors highly sensitive to any transit delays. In addition to crude oil, the strait is also a critical pipeline for liquefied natural gas, or LNG. Qatar, one of the world's largest LNG exporters, sends almost all of its maritime gas shipments through this narrow gap. These shipments represent more than 20% of the global supply of liquefied natural gas. European nations, which have shifted away from Russian gas, now depend significantly on Qatari LNG flowing through Hormuz. This makes the strait not just a regional route, but a cornerstone of global energy security. The strategic importance of Hormuz has made it a focal point of geopolitical tension for decades. Historical precedents show that shipping in the strait has often been directly targeted during regional conflicts. During the Iran-Iraq War in the 1980s, both nations engaged in what was known as the Tanker War. Over 400 merchant vessels were attacked in the Gulf, forcing international navies to escort commercial ships. Because of its geographic position, Iran controls the northern coastline of the strait, giving it immense military leverage. Over the years, the Iranian government has repeatedly threatened to close the strait during times of high diplomatic conflict. This threat is known as the ultimate economic leverage, often referred to as the energy option. Iran's military has developed advanced capabilities, including sea mines, fast attack craft, and anti-ship missiles, designed to target shipping. By deploying these assets, they can disrupt commercial shipping without needing to establish a full naval blockade. The United States and its international allies maintain a persistent naval presence in the region to counter this threat. The U.S. Navy's Fifth Fleet, headquartered nearby in Bahrain, acts as the primary guardian of commercial shipping in these waters. The primary mission of this coalition is to ensure the free flow of commerce in accordance with international maritime law. Any escalation of tensions in these narrow waters immediately triggers a rise in global oil prices. Traders and energy analysts apply what is known as a geopolitical risk premium to crude oil contracts. This premium reflects the fear of supply disruptions, adding several dollars to the price of a barrel even before a single drop is lost. In mid-2026, regional dynamics continue to keep markets on high alert, with security incidents frequently impacting sentiment. To understand the economic fallout of a complete blockade, we must analyze the direct impact on oil markets. If the Strait of Hormuz were closed, 20 million barrels of daily oil supply would be instantly cut off from the world. Economists project that such a massive supply shock would cause Brent crude prices to skyrocket immediately. Many forecasts estimate that oil would easily breach $100 and potentially touch $150 per barrel. An oil price shock of this magnitude would act as a massive tax on global consumers and businesses alike. It would immediately drive up the cost of manufacturing, agricultural production, and global freight transportation. Because energy is a fundamental input for almost every industry, higher oil prices feed directly into consumer inflation. The cost of gasoline, heating oil, and industrial fuel would surge, squeezing household budgets in a matter of days. Inflationary pressures, which central banks have worked hard to bring down, would quickly surge back to dangerous levels. To combat this renewed inflation, the Federal Reserve and other central banks will be forced to keep interest rates higher for longer. Higher interest rates increase the borrowing costs for corporations and home buyers, dampening economic growth. This monetary tightening would also cause government bond yields to spike, increasing the cost of national debt service. The resulting combination of high inflation and stagnant growth could trigger a global recession, commonly known as stagflation. Beyond the direct loss of oil, a crisis in Hormuz would also paralyze the maritime insurance market. Insurance companies charge premiums based on the risk of cargo damage or ship seizure in conflict zones. During a blockade, these war risk insurance premiums would rise to astronomical heights. For many shipping companies, the cost of insurance would become so high that operating in the region would be financially impossible. This would effectively halt all commercial traffic, regardless of whether ships are physically blocked or not. Furthermore, the disruption to LNG shipments would create an immediate energy crisis in Europe and parts of Asia. Natural gas prices would spike, causing electricity bills to climb and forcing heavy industries to ration fuel. The chemical, steel, and fertilizer industries would be particularly hard hit, leading to supply shortages for other products. This shows how a localized maritime blockade can quickly transform into a global industrial crisis. In response to these vulnerabilities, regional nations have built several bypass pipelines over the years. Saudi Arabia operates the East-West Pipeline, which can transport crude oil from its eastern oil fields to the Red Sea port of Yanbu. This pipeline has a capacity of around 5 million barrels per day, allowing some oil to bypass Hormuz entirely. Similarly, the United Arab Emirates operates the Habshan-Fujairah pipeline, carrying oil directly to the Gulf of Oman. This UAE pipeline has a capacity of approximately 1.5 million barrels per day. Iraq and Qatar have also explored overland routes, but these projects require massive capital and cross multiple unstable borders. While these pipelines are highly valuable strategic assets, their combined capacity falls far short of the Strait's daily volume. Together, all active bypass routes can handle only a fraction of the 20 million barrels that flow through Hormuz. Additionally, these pipelines do not solve the problem of transporting Qatar's massive LNG exports, which cannot be easily piped overland. Liquefied gas requires specialized refrigeration plants and ports that are located almost exclusively within the Persian Gulf. Therefore, despite these infrastructure projects, the world remains fundamentally dependent on the physical strait. The threat of disruption also has a significant psychological impact on the financial markets. Stock markets are highly sensitive to geopolitical uncertainty, which drives capital out of equities and into safe haven assets. During a Hormuz crisis, stock indices worldwide would experience significant sell-offs, particularly in tech and manufacturing. Investors would rush to purchase gold, U.S. Treasury bonds, and the U.S. dollar, causing these assets to appreciate. A stronger U.S. dollar would, in turn, put immense pressure on emerging market currencies and increase their import costs. This flight to safety increases the borrowing costs for developing nations, exposing them to debt defaults. Global supply chains, already strained by regional conflicts, would experience widespread shipping delays and logjams. While these dynamics represent a worst-case scenario, the probability of a permanent closure remains relatively low. A complete shutdown of the strait would also devastate Iran's own economy, which relies heavily on maritime trade and oil exports. It would invite a massive military response from a global coalition of consuming nations determined to reopen the shipping lanes. Regional powers, including China and neighboring Gulf states, would exert massive diplomatic pressure to restore stability. However, even temporary disruptions or localized attacks on tankers can create prolonged market instability. For investors and policymakers, managing the geopolitical risk of the Strait of Hormuz is a constant challenge. Diverting supply chains, building strategic oil reserves, and investing in domestic energy production are all parts of the response. Many countries keep strategic petroleum reserves that can be released during a crisis to temporarily stabilize energy prices. But these reserves are finite, usually lasting for only a few months under normal consumption patterns. But as long as the global economy remains dependent on fossil fuels, this 21-mile strait will remain a critical point of failure. In the coming years, the transition to renewable energy may reduce the strategic importance of Middle Eastern oil. But for the foreseeable future, the Strait of Hormuz will continue to hold a massive sway over global inflation and growth. For general analysis and educational purposes, always keep in mind that this content does not constitute investment advice. This analysis is designed to help viewers understand the macroeconomic forces shaping global finance. Investors must conduct their own research and evaluate their risk tolerance before making financial decisions. Diversifying portfolios and understanding international trade routes are key skills for modern investors. Understanding these macroeconomic choke points is essential for navigating the complex realities of the global markets. By monitoring these trade routes, we can better anticipate the shifts in inflation, interest rates, and commodity prices. As we look toward the remainder of 2026, the Strait of Hormuz will remain one of the most watched locations on Earth. The delicate balance between regional sovereignty and international trade will continue to test the limits of global diplomacy. And any shift in this balance will be immediately felt in the price of fuel, electricity, and everyday consumer products. The cost of heating, cooling, and grocery shopping is fundamentally tied to the security of these narrow shipping lanes. It is a vivid reminder of how closely connected our financial systems are to physical trade and geography. We will continue to track these developments and provide detailed economic analysis as new data emerges. For more deep dives into global